This is video 7 dealing with the example that combines IAS 8 with IFRS 9 and specifically share transactions in IFRS 9. We are having a look at the error note. So if you have an error note and even if you have a change in accounting policy note, the first thing you need to do is say what happened. So in this case, what happened was that the investment was recognized at inventories. So they explain it a bit further. They say the investment was measured at cost plus transaction cost initially, subsequently at lower of cost and NRV, because those are the inventories rules. What should have been done? Well, the investment should have been accounted for as an investment in terms of IFRS 9. It should have been recognized at fair value. It should always exclude the transaction cost initially and on year end. So you first write a little paragraph explaining how it was, what happened, what was done, what should have been done. Then you need to say very specifically, could you go back retrospectively? Sometimes it's not possible, especially if there are many years that you have to go back. You might just not have that information. Your accounting system cannot give you that information, can't go back that far, can't change the way it calculated things. There are times when you don't have enough information. Then you need to say very specifically, I could only go retrospectively this far. In this case, it was 2009 and 2010. You could change both, so you could go full retrospective. Then if we look at the table that you put in an error note, and there's one big difference between an error note and a change in accounting policy note, and that is if you look at the columns. So in this case, we have the opening balance of the prior year column. That will be then an error note and a change in accounting policy note. Then we have the prior year, period specific. That will be in an error note and a change in accounting policy note. What you do not see in this note is the 2011 year. 2011 is the current year, the year that you are busy with, the years whose financial statements you are presenting. In that year, if you make a mistake, you will fix it before the financial statements are issued. IAS 8 specifically deals with a prior period error, a period prior to the year you are busy with. So in an error note, you will never, ever see the current year. If you do show us the current year, we will negative mark you. It's a principal error. You're making a mistake. IAS 8 very specifically calls this a prior period error, so do not show the current period. If you had a change in accounting policy, then yes, you would show the 2011 year, because you need to show your users what is the effect on the current year profit, on the current year line item, because I changed my accounting policy. Remember, for your purposes, you do two specific changes in accounting policy: inventories between first in, first out and weighted average, and investment property going from the cost model to the fair value model. If you had one of those, yes, you would show the current year as well. Now, if we start talking about the column opening balance of your prior year, what is really important to see here, the first bit of the note has income statement items, statement of profit or loss and other comprehensive income. The bottom part of the note deals with your statement of financial position, your balance sheet, your balances. So if we look in the column opening balance, you can only have balances. There cannot be any amounts next to the income statement items, the statement of profit or loss items, because you are changing an opening balance. Nominal accounts do not have balances. They are closed off, taken to retained earnings. So if you do that opening balance column, you can only have amounts at the bottom part of the note next to the balances. If you bring in amounts next to nominal accounts, next to statement of profit and loss items, we will negative mark you. Again, it's a principal error that you are making. There are no balances there to fix. Opening balances need to be balance sheet items. Now, where on earth do I get these amounts from? I get them from the journal I wrote. what was done, what should have been done. There's a difference. Correct the difference by writing a note and then disclose that. So you get it from the journal entry. Very easy now because you've done the journal entry. If we hadn't asked you to specifically do the journal entry, please do it as part of your calculations, because then it's very easy to find the amounts that you bring in here. Now, if we look at the current year, not the current year, I apologize, the prior year, the period specific, the 30 September 2010 year. Okay, not current. Current is 2011. Please don't bring in 2011. If you look at that column, in that column, you fix this specific period. The accounting system allowed you to do that, plus, more importantly, on your financial statements that you are presenting and disclosing, you will see the statement of profit or loss and other comprehensive income of that year. You will see those line items. You need to show the effect on every single line item, because you do have your comparative period, your prior year, in every single component of the financial statements, in your statement of profit and loss, in your statement of changes in equity, in your statement of financial position, in your statement of cash flows, and in all the notes. You do see your comparative year. So you need to show the effect on every single line item. What has changed? So the first little bit that you do, the top part of your note, that is your splocky items, your statement of profit and loss, your income statement items. What happened? Where do you find these line items? How did we now know it's revenue and cost of sales and other expenses and other income? How did we know that? We look at the journal entry, the correcting journal entry. What was done, what should have been done. Fix it, correct it by writing a journal, and then do the note, disclose it, show every single line item that was affected. Line items, guys. So you won't see here transaction costs, because that's not a line item. The line item is other expenses. You won't see here fair value adjustment. That's not a line item. The line item where fair value adjustments are included are either other income or other expenses, depending on the direction of the fair value adjustment. So show the effect on every single line item that was affected because of the correction of the error. If we then go to the bottom part of this note, remember now we said this bottom part is about balances. What balances were affected when we corrected this error? Well, inventories, we took it out of inventories, we brought it into investments, and retained earnings was affected. It's really, really important to understand that you are working with balances here. A balance is a cumulative thing. It adds up over time. So when you look at the effect on the inventories balance, the amount, it needs to take into account everything that changed in the opening balance of inventories plus your prior year. What happened in the opening balance? That was the first journal we wrote. We corrected opening balances. What happened in the prior year? That was the second correcting journal we wrote, fixing this specific period. If you look at the closing balance of inventories, it needs to take into account everything, not just the period-specific journal. Even though it's lying in the column 30 September 2010, it's not only the 2010 period specifically, it is everything that affects the balance at the end of 30 September 2010 in your SFP. Cumulative balances, everything that changed in opening balances plus everything that changed in the year. The same applies to the investment. The change you are showing here is what is the change in the investment closing balance cumulatively. Everything that changed. It's not just how you wrote the correcting journal for the specific period. It includes the effect on the opening balance plus the effect of the specific year. It has to include everything because it's a balance. The same applies to retained earnings. It's a balance. So it takes into account what happened to the opening balances and what happened in the current year. All of that together is the effect of correcting this error on the closing balances. There's not a journal, a correcting journal for these closing balances, because if you have changed the opening balance and you have changed this specific period, the accounting system will automatically update the closing balance. But you need to show your users in the error note how much did the closing balance change with, because they are looking at the financial statements. They're looking at the statement of financial position. They are seeing what you have there for investments. When they look at the financial statements you published last year, there wasn't even an investment. How much did that line item change with? How much did the inventories? Balance, cumulative, all changes taken into account.